Good day again, economic students. Welcome back to another video. The purpose of this video is an extension of money and banking, which we started in the previous video when we examined what is money. We defined money. We explained the functions of money. We looked at defining the M1 and M2 as the money supply. And then we talked about what gives money its value, such and such. And now we're going to go into a detailed explanation of the money markets. So here's a graph of the domestic money market. So supply of money, vertical. The Federal Reserve controls the nation's money supply. So think of the Federal Reserve as having its hand on top of that S subset M curve and being able to increase or decrease the money supply. Also remember that S, that in this case represents M2, which is coins and cash, which we call currency, plus checkable deposits, plus all near money, savings accounts, money market accounts, and small time deposits. Right? So that's the definition of money, or the supply of money that the Federal Reserve is most interested in watching. And then we'll go into some detailed explanation of what makes up the demand for money in the next few slides. But what's being measured on the vertical axis and what's being measured on the horizontal axis? Let's do the horizontal axis first because it's simple. Horizontal axis is simply quantity of money demanded and supplied. The vertical axis, we don't call it the price of money, we call it the domestic real interest rate. So you see there's this rate of interest, okay? So when you get equilibrium in the money market, a certain supply of money, a certain demand of money, it yields the interest rate in the economy. So as pictured on the slide here, the interest rate is 5%. Now, interest rates are extremely important. Remember, we already covered the investment demand curve, and we explored the relationship between the real rate of interest and the expected rate of return on any business investments. So you own a warehouse and you're thinking about expanding your business to another warehouse. It's okay. What's it going to cost us to borrow the money? It's going to cost us 4%, right? It's going to cost us 5%. It's going to cost us 6%. In this case, we look and say, okay, in this economy, the rate of interest is 5%. Is the expected rate of return on our business expansion greater than 5%? If so, it makes sense to borrow and invest in new capital. If not, that doesn't make any economic sense. So we already covered that with the investment demand curve, and you understand that lower interest rates stimulate gross business investment or increase the opportunities for business to look for new projects where they buy machines, equipment, tools, factories, such, right? And higher interest rates tend to slow gross business investment. Businesses don't find as many new projects to be as profitable. From the standpoint of the consumer or consumption expenditures, interest rates impact automobile purchases, home refinancing and home purchases. It even affects people's disposable income from the standpoint of student loan and student loan debt, something most of you will have to worry about in the near future. So it's extremely important to understand why we're studying the money market to begin with. Interest rates impact economic activity, have a large impact on economic activity. What makes up the demand for money? What makes up the demand for money? Okay, the demand for money. First question is, why would people want to hold money, right? Why would people want to hold money? On the previous slide, we saw the demand for money. That's the total demand for money. But there's two aspects of the demand for money. The first one is what's called the transaction demand for money, right? And the transaction demand for money, as it turns out, varies directly with nominal GDP. So think of it as in these terms. Every single solitary time an economic transaction takes place, we need money available to facilitate that exchange. So you go down to a good old coffee shop and you take out $4 to buy coffee and a bagel, right? You need $4 worth of cash to make that exchange, that transaction take place. If I were to purchase, say, something more substantial like, I don't know, paint for my entire house, right? So it's going to be $1,200. We need money to facilitate exchange. Now, the reason why it varies directly with nominal GDP is because people pay for goods and services in dollars today, what the actual price of the goods and services. So if the economy were to speed up a bit, if economic growth were to increase slightly, there would be an increase in the transaction demand for money. We'd need more money to facilitate more exchanges. Therefore, there'd be an increase in the transaction demand for money. If the economy were to falter, if we were to slip into a recession, we would expect the transaction demand for money to slow or to shift leftward, to be less transaction demand for money. The interest rate has nothing to do with the transaction demand for money. But when it comes to the asset demand for money, right? The asset demand for money is like, okay, you can hold money. It's an asset. You can store a value having money. But it's costly to hold money as an asset because when you hold cash or cash equivalents as an asset, you forego interest. In other words, if you had $5,000 in cash in your bedroom under your pillow, or you had it, stuffed in some safe in your closet in some clandestine place, you're foregoing interest. In other words, you could have taken that cash and purchased an interest-bearing bond, and you could have received money for lending out your cash to the government or to a corporation, right? So the idea of opportunity cost. What's the opportunity cost of holding money as an asset? So the reason why the asset demand varies inversely with the interest rate is because when interest rates are extremely low, there's not much opportunity cost of holding money as an asset. Think of it like this. The last few years, money markets were yielding less than 1% interest. So if you had $100,000 in cash, you were only giving up something like $700 in interest for the year. Now, that's $700, but on $100,000, that's not a tremendous amount of interest. Back in the 80s, interest rates were 8%. Right? Back in the 70s, interest rates were 9%. So if you had purchased $100,000 worth of bonds with your cash, you would have received $9,000 in interest. So therefore, you would have said, man, there's a huge opportunity cost of holding money as an asset. Low interest rates means that there's going to be more asset demand for money. Higher interest rates, investors, spenders, people in finance will realize the opportunity cost of holding money is too great. There'll be less asset demand for money with higher interest rates. Therefore, the asset demand for money varies inversely with the interest rates. So, remember, when we look at the money market graph and we specifically look at the demand for money, the demand for money is made up by both of these factors, or with both of these factors. So the total demand for money is made up, some of it is the transaction demand for money, and some is the asset demand for money. So here we have on this slide the idea of how do we get to the total demand for money. So start by looking on the far right where it says total demand for money. That is what our demand curve looks like, a downward sloping demand curve. How did we get to the total demand for money? Some of that demand is made up of the transaction demand for money, which is the portion on the far left. Some of it is the asset demand for money in the middle. So think of the far left first, the transaction demand for money. If economic growth were to increase a bit, that vertical portion of the demand curve would slide to the right a bit, increase a bit. So economic growth is a bit stronger than expected. We're going to need more money to facilitate those exchanges, increase in the transaction demand for money. If it were a situation like 2008, when the economy slips into a recession, there'd be a decrease in the transaction demand for money. Now, the middle portion of this explanation, the asset demand for money, you can see that when interest rates are extremely high, say 7.5%, human beings, Americans, they only want to hold $50 billion worth of cash as an asset because there's pretty high interest rate. There's a serious opportunity cost to holding money as an asset. With interest rates much lower, say 2.5%, there's an increase in the asset demand for money because there's not much opportunity cost, or a lot less opportunity cost, to holding money as an asset. Remember, we're typically going to be looking at the total demand for money, right? Adding together the transaction demand for money and the asset demand for money. Okay, we have to add this idea to our explanation and discussion. Velocity. First, the definition. What is velocity? Well, it's the number of times that, on average, that a dollar is spent on final goods and services. So if you think like, okay, how many times is this dollar spent on a good or service in a year, right? So it's the speed at which money circulates. Now, the reason why this is an interesting idea is because velocity doesn't remain constant. During stronger economic expansions, we would expect velocity to increase, and during economic slowdowns, we would expect velocity to slow down. So 2007, 2008, 2009, much slower velocity. 2014, 15, 16, when the economy started really cooking at a better speed, a little bit stronger velocity of money. Now, why is this important? First, look down bottom, it says GDP equals P times Q. We already know this. This is something we studied back when we did the National Income Accounting chapter. Gross domestic product can be summed up by taking the quantity of all goods and services produced times their prices, and that gives us GDP. But if we were to ignore the PQ in the middle there, and it says GDP equals MV, the money supply times velocity, right? We could also calculate GDP. This is called the equation of exchange. GDP equals MV. So if we know the money supply and we also know GDP, we can calculate velocity. Or if we were to know velocity, we could figure out the money supply by some algebraic manipulation. The reason why this is important is because later on we talk about the Fed and some of the strengths of the Fed. One of the weaknesses of the Fed is it's not as easy to predict velocity as one might think. This is just something to put in your brain for now to think about until we discuss it later when we examine monetary policy and the strengths and weaknesses of monetary policy. Okay, let's bring our good old friend the supply of money into the equation here, and it gives us the interest rate, right? Equilibrium interest rate in the money market. Let's look at it on a bigger scale. Here's the same idea, right? We have our total demand for money made up of our transaction demand plus our asset demand for money, our supply of money controlled by the nation's central bank, the Federal Reserve, and we have an interest rate of 5% in the economy. The question is, okay, what would the Fed want to do if the economic landscape or picture changes? What if we feel those people in the Fed believe that the economy may be reaching its full capacity level of production? In this case, the Fed would want to decrease the money supply to push interest rates up a bit. So if you remember that idea of demand pull inflation and the idea that too much money chasing too few goods and the idea that in the short run we only have so much capacity to produce and that excess spending would cause inflation, if the Federal Reserve, if the Fed chair and the vice chair and the other members of the board and the FOMC believed that the economy was approaching this portion of aggregate supply, aggregate demand equilibrium, the Fed would want to slow economic activity by pushing up interest rates and by decreasing the money supply. So if you see here, there's a decrease in the money supply from S to S1, or S subscript M to S subscript M1, right? And you see interest rates went up from 5% to 7%. Remember, higher interest rates would slow borrowing. Businesses won't find as many projects as profitable. Less expansion of plant, property, equipment. Less investment in new machines and equipment, tools and factories. And people would buy fewer cars and homes. This would slow economic activity. Now, this is drawn to show an extreme increase from 5 to 7.5% interest. Typically, the Fed moves in much smaller increments. Typically, we talk about quarter point increases or decreases in interest rates that the Federal Reserve attempts, right? But now you get the idea that if the Fed wants to slow the economy, they simply decrease the money supply to push up interest rates. If, on the other hand, this is the economy of 2007, where Bear Stearns is collapsing, Lehman Brothers is collapsing, Countrywide needs to be rescued, and Merrill Lynch has to merge with Bank of America, and the housing collapse is ruining people's livelihoods. The Fed realizes that the economy is in turmoil, and they understand that the Fed can support economic activity, or at least try to get a foundation underneath this severe recession by bringing interest rates down. So how does the Fed bring interest rates down? If the Fed increases the nation's money supply, interest rates will fall. As pictured in this graph, a shift from the supply of money S to SM2, the interest rate falls from 5 to 2.5%. Now here's the good thing. If you understand the idea of the money market determining the domestic real interest rates, and the idea that the Federal Reserve, our nation's central bank, controls the money supply, and you further understand that the Fed decreases the money supply to increase interest rates and increases the money supply to decrease interest rates, you pretty much understand monetary policy. You understand how important interest rates are and that the Fed manipulates the money supply in order to address economic activity taking place in the real world. The only piece of the puzzle we have left to add when we study monetary policy is what tools does the Fed use to either increase or decrease the money supply? That's actually less important, or we should say, that's just how they do it, not why they do it. So, and they'll be easy enough to add to our discussion of the money markets. Now, the book goes into a real good discussion about the buying and selling of bonds and the shortage of bonds, and it's a well thought out and detailed explanation by McConnell. But this is an extremely important idea that we're going to cover here on this next slide. There's an inverse relationship between interest rates and the price of bonds, right? So if you're studying econ or finance, you should have a basic understanding of what this means, because it's referred to all the time in the economic and financial world that when interest rates go up, the value of bonds go down, and when interest rates go down, the value of bonds go up. So a numerical example will serve to explain how and why this is the case. Let's look up top. It says, okay, January 1st, 2014, you can buy a 10-year Treasury for 4%. That's the yield on a 10-year Treasury, right? So how does this work? You're going to let the government borrow $1,000. You're going to lend your money to the government for 10 years, and the government's going to give you 4% on your money annually. And at the end of 10 years, you're going to get your principal and your last interest payments. So if you look below that first line, it says, okay, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Those are the going out 10 years. The first year you receive $40 in interest, as do you receive $40 in interest the second, third, fourth, fifth, sixth, seventh, eighth, ninth, all the way to the 10th year. And in the 10th year, you receive $1,040 because you get your $40 in interest payment and you also get your principal returned. So over the 10 years, you make $400 for holding this bond to maturity. Now, if you had no intention of ever selling this bond, it really would not matter what happens to interest rates. But in the real world, investors buy and sell bonds all the time. So let's think about you as an investor, and you purchase that 4% Treasury in the beginning of 2014. And then the following year, January 1st, 2015, interest rates increase to 5%. So you see how this would work if somebody else bought a bond in January 1st, 2015. The yield on their bond is 5%, so they receive a check for $50 every year for 10 years. And of course, 10 years out, they receive their principal and interest for the last year, that $10.50. But going back to the value of your bond, right? What happens after 2 years if you want to sell your bond, right? Well, if interest rates have gone up, investors aren't going to be as happy to purchase your bond because, it yields less than they can receive from the current yield on a bond. So interest rates have increased, the value of your bond goes down, right? Because if you want to sell it, you're going to have to sell it at what's called a discount. So if you bought that January 1st, 2014 Treasury bond, and 1 year into it, you wanted to sell it, because your bond's only yielding 4% and the interest rate in the economy is now 5%, investors wouldn't give you as much for it. Now, of course, if interest rates had fallen over that period, in other words, if interest rates were 3% in January 1st, 2015, then the value of your bond would have increased, that 2014 bond, right? So that's what we mean by the idea that there's an inverse relationship between bond prices and interest rates. The reason why this is important because one of the tools, or the most frequently used tool of monetary policy, is the buying and selling of government bonds. And it's good to have a basic understanding of the inverse relationship between interest rates and the price of bonds.